Welcome everyone to the Kindle Report, where I share my 40 years of experience to help you manage your portfolios and protect your wealth. Remember to subscribe, like, and share these videos. As we look back on last week, in Sunday night's video, I talked about a very sloppy week ahead. Well, that's not what happened at all. We saw day after day as the market moved higher, as all the metrics that were released, from earnings to the economic reports, continued to support a steady bid. In fact, we didn't even have a downtick last week. With over 1,200 earnings reports coming out, I figured there would be some disasters in there. There were a couple, but nothing that was material to get the market to even downtick. On Friday, we saw the unemployment numbers come out, and they came in a bit better than expected. We saw 1.78 million new jobs, and the unemployment rate was expected to be 10.5. It came in at 10.2. There's very little surprise there, but it was enough to support the market. On Friday, we traded in a sloppy range, but it ultimately resolved itself in the last hour of trade, as there was a nice bid to come in and push the market to close on the highs of the session and the high of the week. Not only was it the high of the week, but we also printed the extreme values that were on the market grid from last Sunday. As we go forward this week, it's a typical week after employment numbers coming out. Very light economic reports to be released. We do have CPI and PPI. Probably the biggest numbers to come out this week are going to be retail sales, which aren't to Friday. And of course, we always have to focus in on the employment claims on Thursday. They're expected to show another 1.1 million claims. Now, we saw last week with the continuing claims come in at 16.1. If that number continues to decline, which I believe it should, this again will be construed as a bullish number. If that number comes in below 16 million, that will trigger market sentiment, I believe, in a positive mode, as we're very close to the all-time high on the S&P 500. In fact, there's a 70% probability that that number will be challenged right now, which is the 3393 level. There seems to be very little to stop the S&P from making a new high. As we know, the Nasdaq has been leading the way up and has been punching out new highs for weeks now. Now the S&P is going to follow, and ultimately I expect the small and mid-cap indices will follow as well. One of the most important things that we'll have to watch this week, if we do print above 3393, is how the market trades after that. These are really critical things that happen in the marketplace, and we won't know until they happen. There's no way to predict it. But if it prints above 3393 and reverses and closes sharply lower, there's a reversal pattern, that will tell us a lot. I don't expect that's going to happen. I'm going to show you a worksheet that I found on my desk from April 30th, and a lot of the numbers that we're seeing right now and we saw last week, what I was projecting back then. In fact, you can watch the April 30th video that I did, and you'll see me talking about these numbers that we've just reached. There were a lot of questions at the time because most of the formation had not been formed yet. There was a lot of predictive math going on as far as where we were likely to end up. In tonight's video, I will go through quite a few details on our database, which continues to rotate. Let's go ahead and take a look at the charts, see what they're setting up for this week. Tonight, we're going to begin at the PortfolioXpert site on the dashboard. Now, this dashboard I'm showing you right now, you can set up a free account on PortfolioXpert.com, and that's expert with no E. There's a sharing feature on this as well. But this goes over all of our output of our database, and this is on an intermediate level. These are trades that are likely to last for 200 plus days. Right now, we have equities 52.88, ETFs 55%, and mutual funds are 66.96. And the reason why mutual funds are so much higher is there's a lot of bond funds in the mutual fund base, which is keeping this number much higher because of the decline in interest rates over the past several months. But as we scroll down, you can see the current bullish percent on equities is 53%. The 66.9 is on the mutual funds is very similar to what I'll show you when we go to the Wavetech dashboard here in just a minute. One of the things you can see in this is that what type of rotation that we're getting by sector. Right now, basic materials has kicked in a lot because of the move in the metals, and we're seeing energy starting to come on a little bit as there was about 2.17% increase in the ownership there. We're still down at an overall right around 40%. It's one of the weaker sectors, but it's starting to come on, and that's one of the places you're going to want to watch here. Healthcare, industrials, or all of these are in the 60 percentile range. Telecommunication services is another laggard. Down below are all the industry groups. The dark green are new buys or a positive rotation in the database. Just expanding this concept just a little bit more, what we're seeing here is on the Wavetech database on an intermediate is 66.78% of all the symbols in the database, or 11,068 symbols are currently experiencing trending formations and are all in some level of different phases of the trend. Also, I want you to notice that the sectors that are long right now, there's 9 to 12 sectors. Energy sector is not long right now. Transportation and utilities are currently flat. The sectors that are long, 44 days ago, we came in with basic materials, and this is at a sector level. So if I click on basic materials, it breaks it down into subgroups as well. So you can see the individual groups, and this is on an intermediate level here. Plastics and chemicals have been one of the strongest. Containers, packaging, forestry has been good. Gold and silver, of course, has been very good. And most of these are in the very beginning of their cycle in their holding period. Now, one of the things on our database, if you haven't watched this channel before, is there is a map of expected holding and returns, and will give you a complete idea of what the models are telling you. There's just not a buy and sell signal. It actually breaks down all of the details, which I won't go into right now. And you can sign up for this product very easily by going to thekindlereport.com/Wavetech. You'll see the link down below. But this whole database is showing a positive rotation. As we drill down into the sectors here, you can see that 76% of all the stocks in this sector are long right now. So there's a lot going on in basic materials. But going over to the daily database and going to the all stats page, something continues to happen as I'm not seeing this type of rotation before. Push back up to 83.21% bullish. Just about a little bit over a week ago, we were starting to see a lot of negative rotation here, and the firmness in the market last week triggered a lot of positive rotation in a database. You can see there was literally 1,200 new buys out between our model 1.2 and 3.2, and all of the metrics on the rotation in the database are bullish, even on the weekly, even though there's not a lot of them. The ratios of buys versus sells are very positive. This is another reason why I'm telling you that we're likely to see a new high in the S&P 500 and ultimately see the small cap and mid cap indices follow suit. Just a quick glimpse into the leadership change that I've been talking about over the past several weeks. This is MDY versus the Nasdaq, and this bottoming formation, it's in the very early stages of seeing new leadership take over. My expectation is that all of the markets, S&P, small cap, mid cap, are all going to start take a lead over the Nasdaq as far as the percentage gains as we go forward. And I've talked about this in great detail over the past several weeks. I believe it's very important to have the S&P, mid cap, and small cap markets start to play catch up with the Nasdaq for the market to remain healthy and in this robust uptrend that we've been in. Going to the S&P 500 cash, we're continuing to see something happen here that is really challenging, I think, based on the volatility that we saw. If you look at off to the left here where my cursor is, what you'll see is that there was expanded volatility. The market grid was this very wide range. Over the past several weeks, seeing a contracting range in the market grid, which tells us that volatility is actually starting to normalize. We've also seen volume and other metrics come in and start to normalize. There's a new volume level, which is about 1 billion shares more than it was prior to the COVID situation. Most likely that has a lot to do with a lot of the new participants in the market. We're going to review the S&P futures here. We're seeing PPM1 at a plus 0.37. Anything over 0.25 is a trend mode. Notice PPM2 is at 0.26 and PPM3 is 0.26 as well. These indicators measure the angle of attack, what level the trend is accelerating. It also tells a lot about probabilities for the markets to decline. Right now, based on the PPMs, the key support levels are down at 32.92, which is quite a bit below the market, but there's less than a 30% probability, even if the market were to sell off hard, that it would decline below that level. In fact, that would be the ultimate buying price. Now, the market grid that we've seen so far overnight, this is the futures. We're seeing the S1 support 33.36. The low overnight's been 33.35, so we traded just through that. We printed just above R1, and my expectation for today, both on the cash and the futures, is going to be S1, R2, possibly printing an R3. Because of the contracted range, the expected range for today on the cash is about 23 handles. It's a little bit wider on the futures. We have quite a few extra trading hours. But the bottom line is that we're looking at an S1, R2, R3 for today. Going back to the cash indice, on a weekly basis, we've also seen a contraction in the volatility, but this upward slope of the market grid is suggesting that there's substantial support now at the S1 number on the weekly, which is 33.34. Notice that R2 is 33.87. The all-time high in the S&P is 33.93. It's likely if we print up there that we're going to go to at least an R3 34.06 on a weekly basis. We could see the extreme at 34.23 by the time the end of the week unfolds. As I mentioned in the opening comments, we don't have an awful lot of news coming out, but we do have the final week of earnings coming out. There's 675 earnings coming out, and if they come in like last week, we're going to see a continuing positive trend in the markets this week. I don't see, based on all the metrics out there, that there's any probabilities any major decline out of this pattern. Reviewing the Nasdaq futures, we're up 975, up less than 0.1 on the session, but the pattern that's unfolding here continues to be positive as well, but it's starting to lag a little. As I mentioned, I believe the S&P, the mid-cap, and the small-cap indexes will continue to play catch-up here. I expect to see a contraction in volatility. So far tonight, we've had 11,073 as a low. 11,078 was the S1 numbers. We'll probably see an S1, R2. All these numbers are likely to be similar across the indexes that I talked about a minute ago. S&P futures and cash, looking at S1, R2, R3 for today. Same here in the Nasdaq. On a weekly basis, we're looking at an S1 and R2 possibility of reaching R3, which would put the 11,500 and change. Right now, the PPM2 on the Nasdaq is 2.12%. This thing is just crazy bullish. We're not going to see the market decline under the 10,500 level is an absolute floor. If we did see it down there, you could buy blindfolded at that level. This market is not going to decline out of this pattern. And like I said, the most likely thing from a Nasdaq viewpoint, the most likely scenario is that we'll see a slight lag versus the other indices. Reviewing the DXY, the dollar index, I've been talking about this for the last several days. There's a high probability that we've made a bottom in the dollar and there's going to be a continued recovery toward the 97 to 98 level. That the 21 period moving average is 97.48. The 40 is 98.56. If you look at the market grid for today, you're looking at a range in the upward range of 93.58 to 93.77, S1 93.24. The weekly graph is much more revealing. You'll see that PPM1 is turning up, about to take out its first derivative, but ppm2 saw a sharp downtick. What that tells us is that the major resistance right now is back at that 200-week moving average. We're likely to see a multi-week move back toward the 10-period moving average on the weekly. You'll see on the grid here, 95.68. On the pop-up, it's 95.68. If we look at the grid for the week, R1 is 93.82. I think that will be the top end of the range, but could print up to R2. I believe this market will continue to firm up and we'll start to see a larger intermediate bottom form. Next market is gold. We saw something unique on gold, and I've been talking about this over the last couple of days, as it looks like we got a substantial reversal pattern. We were able to make a new high, traded up to the 2089 level, and then reversed and finished near the lows of the session at 2028. Now this pattern it's set up is substantial, and it was also an outside reversal. A lower close today on gold would suggest that we would see at least 2, possibly as many as 3 days lower on gold, and we'll look at the weekly chart to determine where those prices might be. So far tonight we've had a low of 2028. If it remains above the S1 number, it's likely we could see an S1 R2 number, which we printed very close to, which is 2051. If it gets above that level, the next resistance level will be that R3 number. Let's go to the weekly, because this will be the most significant chart to keep an eye on this week as far as the expectations for gold is. The market grid suggests that R1 is a very substantial resistance, but we have R1, R2, 2051, 2077. S1 is 2004. That will probably be the lower end of this market. If we did trade below 2004, 1978 is going to be an extreme number. I don't see us getting below that number at all, and most likely will remain above 2000, at least for the next several days, until we see more of the action for this week. For this week, expect to see an S1 R2 week. If we traded above R2 at 2077, then next resistance 2103. Certainly anything's possible at the level of volatility that we've been seeing in the metals markets. The final market tonight will be silver. Now the configuration in silver is not as negative as the gold, and we continue to see some monster volatility. It's up 3% overnight right now, and it would have to close lower to confirm the reversal. It's likely that silver is going to lead the market sentiment in the metals, keeping this thing positive, unless we were to see a collapse later this day and close at 27.54. This market is also going to end up in a sideways range. I do think that the reversals both on gold and silver were significant. I believe they have something to do with the stability in the dollar. And when we look at the weekly graph here, it's still very positive. We see a massive acceleration. ppm1 plus 0.54, ppm2 plus 4.11, and ppm3 plus 1.52. These are incredibly strong trends that are underlying this market, but all of these moving averages are substantially below the price action, and this is a weekly. It will take approximately 3 weeks for the moving averages to catch up where the market action is if we stay sideways. Now, these type of runaway markets, like we've seen both in gold and silver, are likely to hit an extreme, which, based on the reversal pattern that we saw on Friday, this is possible that we've seen that point in time. The next event then will be a high-level consolidation, which is likely to unfold for a number of weeks. If you own gold and silver, I would continue to hold those positions. But as far as new positions at these levels, I'd be really cautious here. As far as the weekly grid goes here on the silver, somewhere between 26.50 and 25.25 would be the ultimate buy for this week. But that would be for a trade. It would be very difficult if you haven't owned these markets that come in at these levels. This will complete the video for tonight. Thank you so much for watching. We'll talk to you tomorrow night.